Hey guys, welcome back to the channel. Today I'm going over an ETF. It's a covered call ETF that I've been meaning to go over for since August or so, and I've just been putting it off, but today we're going to go over it. If you like QYLD, you may be interested in this one as well. There's some pros and cons, of course, just like all of them. But we'll go over that. I'll let you know my thoughts. We'll do some comparisons and see how they work and all that good stuff. So if you're new here, please like, share, subscribe, do all that good stuff. Down in the pinned comment down below is affiliate links and ways you can help support the channel. You know, just like, sharing, and subscribing is a good one. We just cracked 2,900 subscribers, so would like to see that 3,000 subscriber mark hit by the end of the month. That'd be cool. But I appreciate all of you. Hope you guys enjoy. If you do, let me know. If you got any suggestions, also let me know down below. So what are we looking at today? We are looking at XYLD, not QYLD. We're also looking at we're going to gloss over XYLG as well. Now, XYLD is almost exactly like QYLD, and XYLG is a hybrid. It's a 50-50 mix of XYLD and just the S&P 500 index. So you get kind of the best of both worlds, and I'll give you my thoughts on that. That's only been out for about I don't even think it's been out a year yet. So I did a video on those when they introduced them back then, and I'll link that up top and down below. So what do we got here? Well, we got XYLD, which is the Global X S&P 500 covered call ETF. Okay. It has 145 million in net assets, and they are paying an 8.67% distribution yield. That may be going up. I think they're targeting, I'm not 100% sure, but I think they're going to be targeting 1% of net asset value, but I have not confirmed that. I should have confirmed that before I started the video, but I didn't. I kind of always fly by the seat of my pants, if you guys haven't noticed. So XYLD has a 0.60 expense ratio, just like QYLD. No rating from FactSet. It's got a 3-star from Morningstar. I think QYLD has a 5-star. I don't know if that's because of the net assets, because I think QYLD is well over $1 billion in net assets, and this one hasn't grown. But this has been around for, I think 7-8 years now. So, but this is kind of like the one that no one talks about, because it's not QYLD. The NASDAQ just has been, in so much favor lately that the S&P 500 in this strategy kind of has gotten overlooked. So what is QYLD? Let's take a look at it. Let's go to the portfolio composition, and we will look, and of course it's essentially just the S&P 500. So it's going to have 500 stocks, or 507, and it's going to be mostly North America, a little bit of Europe, mostly the United States. Top 10, the usual suspects of the S&P 500. Apple at 6%, Microsoft at 5.4%, Amazon at 4%, Facebook at just under 2%. Google has about, what is that, 3.5 or so. Tesla at 1.5. Berkshire Hathaway at 1.5, JP Morgan at 1.4, J&J at 1.25. So just, 500 of the best companies that America has to offer, right? And then, of course, what QYLD does, XYLD does, with a twist. Okay, and we'll go over that. Let's see, where am I at? Right here. So this is the XYLD, and this is what their objective is, right? So the Global X seeks to provide, the XYLD seeks to provide investment results that correspond generally to the price and yield performance before fees and expenses of the CBOE S&P 500 Buy Right Index. Now what that is an index that tracks a tracks the S&P 500 as they sell covered calls at the money or close to the money and let them expire every month, and you collect the premium and pay it out to the investors. But there's a little bit of a twist to this compared to the QYLD. So the QYLD does the same thing, but they buy back the covered call the day before it expires. And we'll look down here and see what that twist is. So the covered call option component down here, I'll read this off to you, is subsequent to the settlement of the expiring call option, a new at the money call option expiring in the next month is then deemed written or sold, a transaction commonly referred to as a roll. So the covered call options that they sell every month on the S&P 500 index, they don't let them expire. They buy them back and they sell the new one on that Friday of expiration. Okay, so every month they do that. Now, I don't know if that makes a big difference, you know, comparing the way the QYLD does it, but that is something to think about. That is the twist that XYLD has. The strike price of the new call option, which is the price the covered call option can be exercised at expiration, is the S&P 500 index call option listed on the CBOE with the closest strike price above the last value of the S&P 500 index reported before 11 a.m. Eastern Time. And that's on the Friday of the monthly expiration. So example, if the last S&P 500 index value reported before 11 a.m. Eastern Time is 901.10 and the closest listed S&P 500 index call option strike price above 901.10 is 905, then the 905 strike, the S&P 500 index call option, is selected as the new call option to be incorporated into the index. So they just keep doing that and doing that and doing that. Unless the, that's a good question. If the S&P 500 actually falls below the strike that they sold, will they roll that? That is a good question. We'll have to figure that one out. There's no answer to that one. I looked through some of the prospectus and it doesn't mention that. So, now you also have the XYLG, right? The XYLG, I'm not going to go too in depth with this one, but it's basically half. So what they do is, instead of 100% of the value of the fund being sold as an index option, they're only going to do half. So half of it's going to be XYLD, and the other, and only, sorry, the way they work these ETFs is they buy the stocks and they hold the stocks. They don't necessarily sell the options on the stocks that they hold. They're selling the options on the index separate from the individual stocks. I hope that makes sense. So in XYLG, what they do, instead of doing 100% of the value of all the stocks that they hold, on XYLG, they only do half of it. So you would expect about half the distribution yield with an XYLG, but you will expect more growth because only half of it is being held back from that covered call option. I hope that makes sense, because the covered call options capture upside, right? So QYLD, XYLD, they're writing the covered call at 100% of the value of the fund. So you can only go up to that, right? With XYLG, they only write it on half the value. So half of the value, half of the index returns can still get to you. I hope that makes sense. I hope I explained that well enough. But that's the XYLG. Now, my opinion, I wouldn't hold the XYLG. Why, you say? Because of the expense ratio, 0.60. Okay. Now you can buy the XYLD, right, yourself instead of the XYLG, and then also buy like VOO, which is the S&P 500, at a very low expense ratio. So you can cut this expense ratio from 0.60 to about a 0.32 net, right? If you managed, you know, the holdings, right? Holding 50% XYLD and 50% VOO, because the VOO has almost a non-existent expense ratio. So your complete portfolio, if you had 50% XYLD, 50% VOO, would be roughly half that. So about 0.32 roughly is what your portfolio expense ratio would end up being. I hope that makes sense, because it's late at night and I'm recording and I might not be explaining myself exactly right. So there's XYLD. You know, is that going to interest you? It's going to give you about a 8%, 9% dividend yield, right? Is that what it says? Yep, 8.86% distribution yield. Pays monthly. That's good. And it's on the S&P 500 instead of the NASDAQ, so you might have a little bit less volatility. The interesting thing, though, is when we look at the performance of XYLD, and we'll compare this to, let's compare this to QYLD. I'm suspecting that XYLD has underperformed quite a bit. And we'll look here. And yes, you can see from December 12, 2013 through close today of March 18th, XYLD has only returned 38.4% over that time period, while QYLD returned 73.49%. And that has to do with, you know, the NASDAQ, right? Another interesting thing that I saw about XYLD is back in the March crash, it actually crashed a lot further than it looks to be a lot further. I should have brought that up. Actually, let's take a look at that. Let's look at the March crash, March 15th of 2020 to today, and see how that looks. And we'll look at that. And we'll look at that. So XYLD from the crash onward has outperformed QYLD by about 4%. So it recovered well. So QYLD has been under pressure lately. That's probably why the NASDAQ has been kind of taking a beating here in this past month or so. It really has, and the S&P 500 has held up pretty well. So that's XYLD. What are your thoughts? Leave me some comments down below. My thought is it's a good way for income if you don't like the NASDAQ and you don't like the volatility of the NASDAQ. If you don't like tech as much, even though XYLD and the S&P 500 is still pretty heavy tech, it's not as heavy as the NASDAQ, which is QYLD. So let me know your thoughts. I gave you my thoughts. I think XYLD, I think it's okay. You know, there's nothing wrong with it. It gets you a good, decent yield. XYLG will get you the growth, but I don't think it's worth it as a standalone. I think you'd be better off buying XYLD / VOO in a 50-50 mix, and that way you save on expense ratio and you get basically the same performance. So hope this was helpful. Leave me a comment down below, like, share, subscribe, do all that good stuff. You guys have a great weekend, and we'll talk to you later. Thanks. Bye-bye. I am not a financial advisor. The information contained in this video is for entertainment and informational purposes only. It is not intended to be investment advice. Please seek a licensed professional for any investment, tax, or legal advice. Thank you.